Kia ora ana tātou katoa, tēnā koutou katoa. Martini, mamano, karapa te whai. Many hands make light work, and I think that will be the theme of what I want to talk about this morning. I'm going to be quite unusual. Someone's left their iPad here, is it? Can I Google anything? I'll set up Netflix while we're here. But many hands make light work, and over the last 12 months, New Zealand has proved that. Globally, that has been the call. And really what I hope we can do is bottle that spirit, bottle that idea, and continue to use it going forward. And so this morning I'll chat a little bit around where we've come from over the last 12 months or so. It feels like a much longer period than that for all of us, but also the issues that we face in the near term ahead, and there will be no surprises. I do want to say thank you, Victoria, if you are still logged on. Your speech was a fantastic setup for what I have to say, and truly that spirit of the central bank working with other government agencies, but also especially industry, was incredibly important. That two-way flow of information, identifying risks, liquidity issues, so on and so forth, was critical to our success. And kia ora, Alan, I haven't broken it yet, but I've given it a good crack. Your old shop of Te Pūtea Mātua, the Reserve Bank. Suffice to say, there's no corner that has gone challenged or turned upside down to see how we can keep things going when our traditional tool, the official cash rate, started to run out of room. So it was wonderful. The foundations that previous governors have left was a great place to stand. Kia ora, Neil. I promised to be on best behaviour. Professor Neil Quigley is not only the boss of Waikato University, but he's also my boss as chair of the Reserve Bank of New Zealand. Thank you for your support over recent periods of time. And don't feel personally insulted that no one's joined the table with you, Neil. That's just your mana in the room. That's on the way through. This speech, I'm going to try something different, which is actually try and stick to script. So far, I've failed because I haven't even looked at it yet. So I'm going to turn to it. The speech is actually on the record. All talks we do really are, but in this sense, there is a printed form. So should you fall asleep or go and get coffee, you can go and read it afterwards. And in that speech, it's also got diagrams and pictures, which I know economists are very excited about, graphs and tables, all of those key things that we live and breathe from and make a living from. So in a sense, in the beginning, through 2019, certainly late 2019, the world began watching this COVID-19 virus unfold from a local through to a global pandemic. And we were all watching, particularly decision makers who were faced, global decision makers, with this horrible choice of whether to intervene directly, potentially threatening lifestyles, livelihoods, to contain social movement, or to whether let this thing run its course and try and continue lifestyles and livelihoods as it was. And that choice was very rapidly resolved for policymakers, not by them, but for them, by the fact that global hospital systems were very, very rapidly overrun. And hence inaction was not a policy option, and immediate action was taken almost instantaneously across the globe, showing how globally connected we were. And that in itself has become what you'd call these constraints on social mobility. And that constraint on social mobility has been the number one constraint on economic life as we knew it prior to the COVID-19 virus. In New Zealand and at Te Pūtea Mātua, the Reserve Bank, yes, we were also watching as well, along with the rest of the world, and watching how the response to the virus, or how the virus itself was spreading, and how the policy responses were leading from a health issue to a pending economic crunch. It was, as always, a very unique period. One of the wonderful sayings, and I see Leo and Iris here who have sat through many monetary policy committees, times were more unusual than usual. Almost every monetary policy committee started with people saying times are more unusual than usual. So we kind of almost had finally some actual evidence it was. The good news for the citizens of Aotearoa and certainly the members of Te Pūtea Mātua, the Reserve Bank, was that we ourselves had been preparing for a long time, not just watching, worrying and waiting. We were also doing some mahi working, the fourth W there, around preparing New Zealand to increase its financial resilience, its financial stability. And again, Victoria touched on a few of those issues. Most of those things, like humans do, we were busy taking lessons from the previous war to try and fight the current one. And the previous economic challenge was the global financial crisis and all of the factors that unfolded from that. Very different situations around how it started, what it meant, where it was centred, etc. But we were still working through that, and fortunately a lot of the work that we had either finished or we were in train of putting into place has proved very useful. That resilience was working across bank capital, bank risk management, liquidity management, governance, conduct and culture within the banking sector, the ability to make the financial system more resilient through time to economic shocks. There's that resilience word again. Our work also was on how do you operate monetary policy in this extremely low and persistently low inflation and hence low nominal and low real interest rates. Because what that meant was that central banks' policy tools, the traditional tool, the price tool of the short-term interest rate that can impact somewhere along the yield curve. I understand Leo and Iris, you're going to tell us how far it can impact later this afternoon. But we are working on additional monetary policy tools. I use the word additional because they started off as a working paper on unconventional, then they became alternative, and now I would say they are mainstream monetary policy tools for central banks globally. And so that proved to be extremely timely. We were always doing it in preparedness. A negative or a zero OCR floor was well within an 80% confidence interval, and hence we thought, given our forecasting and accuracies, that was probably well within our chance of hitting it. This was in 2019. We didn't expect to have to be using them so quickly, which was early 2020. But we were in good stead. We'd put out the working paper, we'd got people through the first part, shock, horror, denial, and eventually acceptance came through. And we were doing a lot of other activities, some which proved incredibly prescient, by the fact that you've never heard of them. We were swapping out and putting in a superior payment and settlement system inside the bank as well. It was a 30-year plus real-time gross settlement system. We bank the bank, since they call us a central bank, and those payment and settlement systems, if they can't handle the volume, it's you, the public of New Zealand, who find out first when the computer says no, when you try and get your cash out or make a transaction. Within weeks, the new system was tested extremely well because of the rush to cash and the unusual flows, etc., that we saw going on. So, and the very last part was this wonderful, it had been mysterious, but we want to take the veil away and make it far more publicly obvious, is this Council of Financial Regulators. So the Reserve Bank, one of its roles is obviously the prudential regulator of deposit-taking institutions and insurance, and we've been getting together with other regulators to make sure that we are aligned in what we're doing, that we weren't hitting the industry at the same time on a vast amount of issues, or we weren't turning up for the third time in a row asking the same question from the last regulator. And so that has been a real challenge, and that is coming together. In fact, we had one of our quarterly meetings only yesterday, and there, we're really anchored on core strategic themes that collectively we can work on, show leadership on, and bring in the private sector, non-government organisations, academics, economists around these longer-term challenges that face Aotearoa, New Zealand and the globe. So you will hear more of that. I will say that payment and settlement systems and financial inclusion, remittance stories, as just mentioned, are one of the core types of collective activities we're doing, where regulations don't end up with unintended consequences of countries not being able to access their means of living. So our preparedness efforts certainly proved timely. I won't say it was predicted, it was just timely that we had been doing all of this work. And that, in a sense, is our kaitiaki, our caretaker role of New Zealand's financial system. So that's what you would hope and anticipate from the bank. This is where I eat significant humble pie, because I would say we were far from alone in preparing for such economic challenges and in delivering some of the policy results that we've seen. At best, I would say we were a part player, perhaps a reasonable co-lead or something, but we were far from the lead actor in the response to the COVID-19. The first significant importance of getting us where we are today, and we'll talk about the future, of course, is the platform that had been laid over many decades in New Zealand through economic policy. The low level of government debt has given us plenty of fiscal headroom, flexibility, optionality that hasn't existed, doesn't exist in many countries. And so we were able to use that money for the rainy day. If ever there was a rainy day, it looked like this COVID-19 challenge. We were fortunate to be in a favourable terms of trade position. That was probably more fortunate than planned. In fact, the terms of trade has been one of the most surprising outcomes for Aotearoa New Zealand through this crisis. Traditionally, if you're seeing economic activity globally come to a halt, generally global commodity prices come to a halt, and New Zealand's terms of trade get seriously impacted. That hasn't been the case this time. Being told to go home, stay home, means we can couch surf, so things that you can click and use have done extremely well in market capitalisation, big tech, and we like to consume, and we are a key supplier of consumption goods to the world. So once we got through some of the supply chain issues, our terms of trade have held up very well, and I was pleased to come to the Waikato after yesterday's dairy announcement. I see that the prices are still holding up incredibly strong. So there was a significant suite that had put us in good stead, us being the economy of New Zealand. But, you are listening to a proud governor of the central bank, proud that we were able to contribute as we did. We eased monetary conditions, as Victoria just mentioned. We took the OCR as low as we could go without going to zero or negative. We committed we would keep it there for the 12 months, for the foreseeable future. We committed to that because we were also building additional tools, and we wanted to understand whether those additional tools needed to be deployed and whether they were relatively better or not than an official cash rate at zero or negative. And so we were able to understand against preset criteria, and then through time deploy these new monetary tools, the large-scale asset purchase, which I'll come back to, the funding for lending program, this work that we have been able to get the interest rates by households and businesses in New Zealand as low as necessary to continue to achieve the Reserve Bank's mandate. We introduced an enormous amount of liquidity facilities. Continuously referring to the previous speech. By the way, we didn't practice this before we came. I just want to put that on the record, but if we had, it wouldn't have been as good as it turned out from Victoria. But the liquidity facilities meant that cash was plentiful, cheap and available to the banking sector, and that our financial markets continued to work in a very highly liquid way. We ensured public had continued access to cash. As has been through all previous crises, the first thing that humans do is think about their own personal security, and they seek safety in cash. So we saw this enormous outflow of cash from our vault, small s, and that all went into the households. We're only just starting to see it dribble back now. So when people say we're in a cashless society, no, we're not. We're in a less cash society. People still always seek safety in that side. And we were able to assist the government, particularly with strong relationships with Treasury, in a real-time manner. The mortgage deferral schemes, the business financing guarantee schemes, and the debt issuance programs. And I've mentioned the reprioritisation of our regulatory issues. So they were fantastic, but it was successful not just because, getting these things in place and keeping the shop open, at least to have another go from here on forward, in large part because of our connectedness to the industry, and particularly the banking industry, understanding their operational resilience, understanding their liquidity criteria, the risks that they were holding, understanding what tools would and wouldn't work for them was very, very useful. And there were some lovely, constructive, achievement-focused conversations, which we write in hindsight, but it was tough going to be able to get these types of issues in place. And I've mentioned often in other speeches, you can take the horse to the water, but you can't get them to drink. Some of these tools have worked merely by the fact that they are available, even if they aren't being used. And I'd say our funding for lending program, where banks can come to our window for their wholesale funding, as opposed to relying on deposits or international wholesale markets, even if it hasn't been tapped much to date, the mere fact that it's available, that threat of competition is creating the behaviours that we want to see on the way through. So that is, in a sense, a great outcome. And that is the mahi-tahi story, the working together, recognising that no one institution, no one sector of society can achieve all of this. We have to work collectively on the way through. And if we can keep that spirit going here in Aotearoa, New Zealand, bottle that lesson, it will be a fantastic and strong momentum going forward. This is where I put the warning out. Those who don't like work should leave the room now, because towards the end of the speech I'm going to plead that you help and work with us around one of our challenges in that mahi-tahi spirit going forward. The ability for the economy to maintain the current economic momentum is always going to be first and foremost a function of the health outcomes as we go through this global vaccination challenge. That is in the short term. There's no bigger variable that is going to determine economic outcomes than the health outcome and the policy responses to the health outcome. The opening line of the speech originally said, "It is so great to be here in a broad collective audience of all New Zealand economists, Economic Association," and obviously even between last week when I was writing this and today when I'm delivering it, we're not. That shows how uncertain the environment is that we're working in. So, that's the number one health outcome. But the more medium term, it's really going to come down to, I would say, confidence in households and especially confidence in businesses to invest, to adapt, to go back to, I won't say business as usual, because we won't see that, but go back to long-term business planning, long-term investment. The current pickup has been strongly supported by some significant one-off events. Some of those, I hope, do not have to be repeated. The most significant event was, of course, the balance sheet deck chair swapping that we did from the government's balance sheet into the private sector and household balance sheet through wage subsidies, mortgage deferrals, business financing guarantee schemes. In particular, that wage subsidy was amazingly powerful at giving people, I wouldn't say the confidence to continue to employ people, I would say the capability to. That there was a cash flow to keep people connected to the labour force. You can't keep doing that unless you want to call yourself the Soviet Union in 1922 or something. That is a policy for extraordinary times, and I really hope we don't go back to extraordinary times. There is going to be a long lag now. The global vaccine rollout is fantastic news. It means that the horizon is now, we can now see the horizon towards the end of this current pandemic issue. But the horizon is still some way off, and it's going to be a long period before sufficient immunity, global immunity is there, and before we turn back to whatever the new normal looks like in economic activity. Given that ongoing economic uncertainty, given that nervousness around business investment, given how low inflation has been and how employment remains away from its maximum sustainable type estimates, this is why monetary policy remains very stimulatory, and we made that very clear as recently as last week with our monetary policy statement. The Monetary Policy Committee remains focused on inflation and contributing to maximum sustainable employment, and to achieve our mandate we still need stimulatory monetary conditions. I will come to the challenges that means elsewhere. In fact, I'll do that now because, as we all know, aggregate economic statistics, as exciting as they are, we used to laugh that if your feet are on fire and your head's in the fridge, on average your body temperature is just fine. Economics, the monetary policy, is a very blunt tool, and aggregate statistics mask a huge difference across individuals, sectors, demographics around how we're feeling about it. The challenges that came through were many. The secular decline in nominal and real interest rates up until just recent days has meant that our traditional tools weren't there anymore, and we've had to produce additional tools. It meant that the pace and magnitude of the economic shock, the working together between government and the private sector reached unique high levels. In fact, I would say we outsourced a lot of our policy implementation to banks, to financial intermediaries, whether that was mortgage deferrals, whether that was the deployment of wage subsidies. That was a high trust in the moment challenge, very different to what we consider fiscal policy normally being. How effective was that? I would say globally it was quite timely and effective. I would say here in New Zealand it was very timely and highly effective. In what we achieved, yes, we talk about the residuals, and they are important and they are lingering and ongoing, but for the there and now during the crisis, the ability to cash flow and create the confidence to get us through the first wave of the pandemic was very strong. I think also it's really important, particularly for the central bank. We're always about making sure people understand our mandate, making sure people understand our operational independence. A lot of discussion, because of the additional alternative monetary policy tools were there, had people confused around large-scale asset purchases driven by the Monetary Policy Committee to achieve lower interest rates, and money financing the government's fiscal policy. And so just to make that clear, while they are subtle, they appear very subtle in their differences from outside, they are significantly different in terms of institutional structures and the outcomes thereafter. The government's debt issuance through this period has been driven purely by their desires, needs, wants around government spending and government investment, determining the bond issuance program. That is a fiscal policy decision utterly outside of any of the Reserve Bank's mandate or line of sight. We receive this information at the same time the rest of the country receives it. Under the bank's large-scale asset purchasing program, though, this is where we were buying government bonds, we were taking an asset, releasing cash into the banking sector, that the amount and timing of our government bond purchase was driven purely for our Monetary Policy Committee's purposes to achieve low and stable inflation and contribute to maximum sustainable employment. We bought those to lower interest rates and flatten the yield curve as far as was possible and necessary to achieve our employment, inflation, and those decisions were ours and ours alone around the monetary policy. We were actually, when we were doing the research in the background around, well, what if we did a large-scale asset purchase, what would we actually buy? And if you go back to one of the papers we published in late 2019, our number one concern was there aren't enough assets out there to actually buy of sufficient quality and quantity. Well, that was quite quickly resolved by the government's debt issuances. So we ourselves have forgotten about the endogeneity of these things if and when we use it. And of course, the financial implications of the Reserve Bank's balance sheet increasing as we take these assets on and swap it out for cash has been, in a sense, indemnified through Crown indemnities. You know, the Reserve Bank's balance sheet, it just sits on the whole Crown balance sheet. The fact that we're holding, the mark-to-market challenge around that bond, we've received indemnities so that the Monetary Policy Committee remains able, capable, resourced to make the decisions it needs to continue to reach its operational independence. In a perfect world, the bank would have had sufficient capital not to have to go through that indemnity process. And that is something that we'll be working on the way through as well. So I hope that helps people separate. It looks like the same from the outside, but what went inside, I won't use the sausage analysis, what actually went on the inside is incredibly different. The central bank remains operationally independent, as does fiscal policy is driven by their needs, their wants. So that was a paid advert for operational independence of central banks, and I hope that was well received. The fact is, why were we so eager to ease monetary policy as quickly as we did? Suffice to say, it should be obvious because we have a mandate to achieve our inflation and our employment targets, low and stable inflation, somewhere between 1% to 3% per annum on the consumer price index, not the house price index, and that was our actions that we're doing it. Like many central banks around the world, because of this very low global inflation, actual inflation in New Zealand has been bouncing around at the bottom end of that inflation target and at times even outside of it at the bottom end. And so we were very keen to head off embedding extremely low inflation and risking deflation. Likewise, unemployment or employment, that's real. It's not some notional concept of the average consumer. We know that if you are temporarily out of the labour market, that's a good indication that you might be more permanently out of the labour market. So making sure that we were contributing to people remaining in jobs through this process was the key driver of our monetary policy actions. With all of that, I will come to the traditional but monetary policy is a blunt tool. We are talking about aggregate inflation, we're talking about unemployment across the economy or maximum sustainable employment. We know that the impact of monetary policy will always and forever have different impacts on wealth and income equality through time. On sectors of society. There might be savers versus investors, old versus young, importers versus exporters. You can cut and dice it in many ways. It is a blunt tool. I do want to say that the literature to date, our best efforts, and this is my first paid advertisement for work, suggests that very low nominal interest rates and very low real interest rates, the research shows it's unclear whether that actually increases or decreases wealth and income equality. It becomes an empirical matter, not a theoretical matter around that equality issue. And so, as usual, and I'm pleased Victoria's just offered her entire balance sheet to all economists in New Zealand. I think that's what I heard, wasn't it? Perhaps not the balance sheet, but at least some good data to really climb into that equality issue. And work around under what kind of circumstances and what situations do you need to how to understand what these equality impacts on income and wealth really do come from monetary policy decisions. Without doubt, though, of course, one of the main channels of monetary policy, well, it's not even a main channel, one channel of monetary policy is through lower interest rates helping to inflate asset prices. Those who own those assets suddenly feel wealthier, they feel more inclined to spend, their spending increases economic activity, increases employment, and we get that wonderful short-term sense of a monetary policy shot to the arm. And so without doubt, monetary policy and interest rates have an impact on asset prices. We're aware of that, we've talked about that forever, it's no surprise. And we have seen that, what I would like to remind audiences, obviously probably more those who are reading it outside of the Association of Economists, but this is through history and a global phenomenon. It is not unique or specific to New Zealand right here, right now. This is often how monetary policy rolls. You've seen that in global equity markets. The number one challenge in global equity markets is, are they sniffing true, real long-term economic returns? Do the current market capitalisations reflect their underlying earnings, expected earnings? Or are they, because the risk-return curve, the securities line has been crushed to zero and flattened, and it's simply a short-term sugar hit to countries? And that means, it's very different implications once interest rates start to rise or monetary policy can renormalise. What does that mean for asset values around? House prices are included in those assets, and of course houses and house ownership in New Zealand is the key asset for households in New Zealand, and more so than perhaps in any other OECD country. I always stand to be corrected on stats, but it is widely held in New Zealand, home ownership, and it makes up over 2/3 of household wealth as best we can manage it. So it is a significant asset, and asset price changes really impact economic activity in Aotearoa. So, that is very clear. While it's wonderful for me to say, look, of course we expected this, oh my God, really, get over it, understand that. That's not what I'm saying. I'm saying it's critical that we, the Reserve Bank of New Zealand, understand those relative impacts that monetary policy can have, shout from the rooftops around that what it is, and talk to policy makers and other parts of our own bank around those implications of wealth equality, income equality, what those implications are. Many of the longer term policy issues and certainly instruments are outside of the Reserve Bank. But we do have both sides, we have both monetary policy and financial stability. So that is the action. Sorry, can I just, how much have I got?
It would be great if you could wrap up so we've got a bit of time for questions.
Oh, okay, no, well my job was to speak right through, so I got no questions.
We've got some great questions coming through.
I think you're confused, I'm from the Reserve Bank. It's, so I will speed through them because, as I said, you can go and see the movie afterwards. I'm just reading the book out loud to you. Really, cutting to the chase on housing, we have received, in fact, I'm going to put this aside. Look at that, I'm over this stuff. This is where I make markets accidentally move because I say something that wasn't in the speech. But that work on housing, asset prices, income, equality, inequality is incredibly important to us, and it's a place where we have recently received, as recent as last week, a new directive from the government, and it's a directive down the financial policy arm of our business, not the monetary policy, not the Monetary Policy Committee remit, but through the financial stability remit, Section 68 of the Act. And Section 68B, you always find out these things when you have to go and search it for the first time ever because someone's asked you about it, says that we should have regard to house prices when setting our financial stability policies. Our financial stability policies are largely related to the loan-to-value ratios, are related to bank capital, bank lending policy. It's all around the financial stability issue. Now, we have always had regard to house prices when setting monetary policy. I've talked about the one channel already, the wealth channel. Incredibly important to get a sense on where the economy is going and hence what we might need to be doing with monetary policy stimulation. But likewise, all things related to housing are included in the Consumer Price Index. Rentals, maintenance, rates. In fact, they make up around 1/4 of the Consumer Price Index. So again, they impact directly on it. And of course, the ratio, the relative buying a house versus building one is an important question mark around whether we see increased building activity. So on the monetary policy side, we've got a good handle on how housing impacts on spending activity and measured inflation. and that is for all to see and has always been there. On the financial stability side, where we have to think hard is around, given the importance of housing, house prices as the asset class and hence financial exposure, how does house price variability impact on financial stability? The good news for banks is that they don't just have the one house, they have a portfolio of homes, and so the stress testing you just heard from around Victoria, it's about how does that portfolio of homes behave dependent on particular idiosyncratic shocks. And it's very hard to upset a lending bank, a well-diversified bank's balance sheet through house price variability, but it's very easy to upset a household's financial variability because they might only have the one. So our work is to say, with a focus on that holistic financial stability role, how do we have regard to house prices in there? And in particular, a word called sustainable house prices. We need to do work around, well, what do we mean by sustainable house prices? What instruments would we have that may be able to impact on house prices and nudge them towards something that we consider sustainable? And what instruments don't we have, either that we could have, deposit to income, debt to income ratios, for example, or that other government agencies should be working on that keep the housing market more sustainable. So our work ahead will be around looking at housing from both the investor perspective and the occupier's perspective. From the occupant perspective, you know, this is the person who actually wants to live in the house, that strange person, as opposed to the ones we hear about too often, the investor who wants to create a portfolio of homes. To live in a home, you're making these economic trade-offs between rent versus mortgage servicing, the fact that you'll own the house at the end if you actually have a mortgage, and hence the expected capital gain, versus putting your money somewhere else, renting and investing everywhere else. So, you know, I think we can boil that down to some sensible aggregate type of statistics. Of course, that's the economic rationale. There's the whole other societal issues around wanting to belong to a community, etc. So those are broader issues around that we have. And on the investor side, you know, a sense around what does an optimal portfolio allocation suggest that, that you might actually have as a household and exposure to all things residential investment, given current settings, policy settings. And if those policy settings suggest that you are continuously overweight housing and investors only and always incentivised to hold more houses, well then are we comfortable with those settings? Are they settings that the Reserve Bank might actually have, or are they policy settings elsewhere? So we're going to play our role, and as usual it's only a bit role in the whole concept of housing, because as we pointed out in our letter sharing with the Minister of Finance, there is a vast array of policy institutions, private sector institutions, non-government organisations who play important parts of housing supply and housing demand. We'll think hard on the demand side. We're only a bit player. We will be highly transparent. We will shout from the rooftops around how we're thinking about it. Our number one nervousness right here, right today, was around the very high risk lending, the high debt lending, in particular to investors, because they are the ones who can most trigger house price variability. It's much easier to enter and exit a home as an owner if you're not also the dweller. And so it's these price variables. This isn't a bash on the investors. The investors play important equilibrium parts of the market, and this is about current homes. It's not about building new homes. And this is why we put our loan-to-value restrictions back on most recently. So in the end, Martini Mamano Karapati Whai, many hands make light work, help please. We're up for it, we've got our work ahead of us, we've started, but we are far from a monopoly on wisdom in this place. Kia ora, me take mata. Hopefully I use up all the time.
Yeah, you stay there if you like, and I'll just grab this iPad, sorry. I'll grab this iPad and go behind you. Well, you did try to use up all of the time, and I could see the strategy, but don't worry, WMS is not to be outbeaten on this. I've just got approval that we can go a little bit into morning tea time, so you didn't take notice of that in the program, did you?
You didn't ask me.
First of all, I'd like to open it up to any questions from the floor.
right?
Okay, no, we have a lot of, a lot of the questions that have been coming through from our online audience are about risk. We understand, everybody understands the benefits of economic policy and the changes and settings that have been needed. But let me start with the first one, because most of them seem to be about risks, whether to New Zealand or other countries. And of course, there's that trade-off. Every time you have an economic policy, there's a risk associated with it. So Adrian, how concerned should we be about huge asset price increases due to low interest rates? How do we balance the possible boost to economic growth with systemic risks?
Yeah, I think the answer should be always and everywhere very worried. Returns do not come free. Returns are a reward for taking on risk. You must understand those risks. You must be able to manage those risks. And at times, that is not how those risks have been allocated. I think about financial stability when all relevant financial risks have been adequately identified. Are we sure of this? Market, credit, liquidity, whatever the various risks are, the terminology you might use. Have they been priced appropriately? And there are periods where pricing is significantly off-piste. And have they been, through that pricing, allocated to people who are best able to manage it? And often that is not the case. It's allocated to a household that may have not even identified, let alone priced that risk. So, in short, big question marks around global equity prices relative to underlying earnings, and absolutely a question mark around house prices globally and in Aotearoa, New Zealand, relative to household earnings. And so take that on board. And I would say the number one way in which a lot of this risk ends up being highly concentrated in housing in New Zealand is the ability to leverage that asset compared to other investments. The fact that we can turn up with a 20% deposit and get a 5-to-1 leverage, that just seems a no-brainer to everyone, but leverage is a significant risk.
Thanks very much, Adrian. And a kind of associated question, I know you spoke a lot about housing at the end of your presentation there, but we've got a question here, how are you going to approach this mandate to housing? What's your approach to it? They're calling it a new one. You remind us it's not necessarily completely new, but how are you going to approach it?
The key thing I wanted to remind first and foremost was that when it was announced, it was conflated with the Monetary Policy Committee mandate. Yes, that committee mandate has changed, but at the margin it is about us saying we have to translate the impact as best we can assess of our interest rate decision, our monetary policy decision I should say, on the government's housing goals. So be transparent about it. And that is a positive thing because that's how we roll anyway. But it's around the financial stability remit. It has always allowed an opportunity for a minister to talk about things we have regard to. We can say we had regard to that and we're going to not do anything because it doesn't fit with our overarching mandate, the financial stability, but this does. The fact that variability in asset prices, overinflated asset prices and house prices amongst that fit into our financial stability mandate, we will be looking very hard around behaviour, demand management behaviour, around how far are prices from some sense of fair value, what that may mean for financial vulnerability and what our instruments may actually be able to do to at least nudge those prices back towards some sense of fair value with that asset class. So, we know our instruments are only going to be partial, but we might as well have, the jib cut to ensure that we are acting as a stabiliser rather than a destabiliser with our financial policy settings.
Yeah, and of course it's one of the frustrations to economists and particularly macroeconomists that we don't have those sharp instruments that we would like, so you're using fairly blunt instruments to try to achieve these objectives.
I'm very pleased we don't have sharp instruments because I know my staff and I'm not sure I trust them with it, but and of course economics is all about relative, so the blunt instruments are what they are. I'd say the number one frustration here and across many countries is truly being able to explain what the key drivers are and getting the people who control those key drivers to have concern or regard to those through time, intergenerationally, not just short term. And I'd say that's around the banks. It was great hearing from Victoria. She said more data, more working together, that's fantastic. But how about a longer term horizon as well for CEOs of private sector companies, rather than just being driven to short-term profit, long-term sustainable profits, would fundamentally change thinking around business practices.
And I think that is important to have a wide range of stakeholders. It's interesting, when I've been talking with some of you guys in the audience, you've been a bit apologetic that sometimes your economics isn't, you haven't studied economics, but actually it impacts all of us. And I think we all need to come to the party, so please don't be scared of bringing up your questions. There's no stupid questions in economics. In fact, sometimes the most challenging questions come from people that might not understand the things that we've been brainwashed into accepting. Adrian, can I take you up? You haven't quite escaped yet. Can I take you up to a little bit of international risk? We've got a question from online about the latest proposed US stimulus package, which is absolutely huge. If that comes to pass, is the world heading towards an inflation problem?
We always put that word problem at the end. Are we heading back to having low and sustainable inflation as opposed to fears of zero nominal bounds and deflation? And that is the single biggest policy question now. We have to liberate ourselves from the fact we happen to have had our working careers since the 1970s and through, sorry, insulting some of you in the room, high stagflation, high and variable inflation. That is not the world we live in now. And it's a world that we want to avoid going back to. Absolutely critical. But the single biggest challenge of the world at the moment is rapidly falling places, deflation and dislocation in labour markets. So, the first and foremost around the world central banks is let's try and overachieve on our inflation targets, because this fear of the previous problem has led to us underachieving for so long. And so, from Jay Powell through to almost every central bank in the world, they now talk about, in very complicated ways, about risking overshooting their inflation targets so that at least on average they're broadly right, because at the moment they have well undershot. The fiscal policy, I would say the biggest concern around fiscal policy, which is why we ended up with independent monetary policy working aggregate demand, is that it is slow to get moving and it's very often not temporary. It's not an ideal tool for cyclical demand management. And, a nervousness that would be out there in the markets has too much arrived too late around fiscal stimulus. And, we'll see that is I don't believe that because I have no idea. But, that is where the markets, for example, at the moment are sniffing to say, wow, is this massive package, is this arriving at the time, about 12 months behind the game? That's why I was so pleased why I put very effective in the New Zealand self-marking exam paper around fiscal policy rather than quite effective. The timeliness was incredibly important.
Interesting comment there, wasn't it? Overperforming in inflation isn't such a bad thing when we're facing negative interest rates. And that was, I guess, my comment earlier about living in Japan. You're facing policies that aren't normally the ones that we might think were great economic policies.
And have to remember, Japan has some lessons, but not that many. Japan was wealthy enough to live with declining populations, staying alive by eating into large savings and incomes. That is not the case for most OECD countries. We would go into deflation with very high debt and an extreme need for nominal cash flow. And deflation is not that environment.
And let's follow on the debt issue, Adrian, because of course we've had a number of questions coming through on this. What's your view on whether we can simply write off debt? Some other countries seem to be adopting a print more and never pay it back approach.
Well, I would strongly disagree with that second statement, print more and write it off. Outside of Venezuela, Argentina and possibly Zimbabwe, the rest of the world is saying to the fact that they are quantitative easing, central banks are buying assets and putting those assets on their balance sheet. They only remain assets if they are worth something, not if they are written off. And that was why I made that important distinction. And I really do hope that economists, give me that name of that person, understand that difference, because we are buying bonds in the secondary market. They are assets on our balance sheet. We are not simply money financing fiscal policy. Money financing fiscal policy is possible, but it comes with a whole different series of institutional structures and unique risks.
It was anonymous. That's a good thing about Slido.
I know
but
that
anyone
person.
in the room who can't necessarily, you can cover your face with your program or something if you like, but would anyone like to ask a question? Yeah, please, go ahead.
What sort of levels of overshooting in inflation would the Reserve Bank be comfortable with?
Just for the people online, what sort of levels of overshooting of inflation would the Reserve Bank be comfortable with, was the question.
Small but perfectly formed.
Grant? Yep.
Thanks, Adrian. Would you be able to expand a little bit on the term sustainable house prices? Does that mean sustaining them at a 20% growth rate per year, or sustaining the absolute level? What do you think? What is your thinking about the whole notion of sustainability of house prices, which seems a bit vague at this stage?
Thank you, Grant. And no, not at 20% per annum, and you know that. But nice, good, cheeky stuff, Grant. For you, it's minus 20. But for the idea and notion behind it is where our thinking will start from, and it will be transparent and greatly assisted by wise folk around you, is really just underlying what would be what drives an asset price, which is some kind of discounted future earnings profile, and hence coming out with some sense of a fair value. Of an asset price. I've spent the previous 12 years with the New Zealand Super Fund, where that's all we ever did, and then we went long or short depending on whether the price was below or above what we considered some sense of fair value. Why could we do that? Because we had patience, horizon and timing to be able to watch these prices mean revert back to some sense of fair value. So there is always some underlying sense of fair value. Even if you're there as the investor, you are going to need someone to live in there and someone who can pay that rent. And if the house price needs to justify a return, then that's a function of the yield, and if the yield is the rent, and the rent has to keep going up and up and up, eventually the house is going to be empty, and what's going to happen to the price? So that's the underlying concept of it. Very easy to explain. Huge, broad measures around what would be fair value, what are zones of indifference around it, and then importantly, what would be a policy action. So for our loan-to-value restrictions, for example, we might have some small but positive restriction on all of the time, just to make sure that people have to stump up and put skin in the game to begin with a deposit on their house. They're not over-leveraged. But through time, if it got too far away, we might be increasing that restriction to make it at the margin for an investor that they have to put more skin in the game, more sides. So that's just, that's at the margin. I can't tell you whether that is going to be successful or not at the time. We only have one small part business cycle where LVRs in New Zealand went on, and they did have an impact on house prices. But in doing that and understanding fair value, we're going to have to do a lot of work, which is going to unveil a lot of policy settings that explain why we are so heavily invested in housing in New Zealand, not just as dwellers, but as investors. And some of those settings are going to come down to uncomfortable facts like access to leverage, the structure of the banking sector, the favourability of some loans versus others, and taxation. I said it. And these are only demand-side setting variables.
Thanks, Adrian. I think we've got a last question there. Eric, do you want a fairly brief question, please, so we can...
Sure, as follow-on. We remember the Greenspan put, I was a little bit worried when the government was giving you more of a housing mandate that you could end up with a central bank put on house prices. And if we were able to get supply conditions where they need to be, there should be a sharp correction in house prices. A lot of housing coming on stream would mean, like even just credible signals of it, should sharply reduce house prices. It would be terrible if the Reserve Bank saw itself as needing to lean against that, or worse, investors thinking that the bank would, and actually that is because it's on the prudential side and not monetary side, maybe you wouldn't. So just some comment on whether there's a housing put we need to worry about, and a suggestion. If you're going to be watching long-term house prices as part of something you need to be monitoring, the Case-Shiller indices in the US are wonderful. We don't have them here. It's possible to build them here, but it would probably take a bit of bank support because of just the costs of setting up the financial instruments on it, somebody making book on it, all of the thinness in expected markets. There hasn't really been investor demand, or the markets haven't seen there being sufficient investor demand to front the cost of building the thing. Some bank help in getting those going could yield something really useful as forward indicators on house prices.
Yeah, I 100% agree on everything Eric said. More data is critically needed. The data is not unique in what we need to create. It would just be unique in assembling it here in Aotearoa, New Zealand. And that's, some of the work we've got. I am very well aware of some of the work both with an ASB but also other banks in New Zealand where they really are turning to exploiting their data to understand this work, and they are being very open with us around making sure this is anonymised. And on the Greenspan put, I think the really critical thing for markets to remember is this is around our financial stability policy tools. It's not about our monetary policy commitment. If we raise interest rates today, it makes housing less affordable but house prices lower. If we raise the LVR today, again, it does the same. There is a time trade-off through all of this. We have to think through that carefully. I feel sorry for some of the current generation of people wanting to be first home buyers. It's going to be hard. Kia ora. Thank you.
Thank you very much for that, Adrian. Excellent presentation. I'll let you off the last question, which was, are you going to raise interest rates this year? Because I doubt that we were going to get a very clear answer on that one. But thanks very much for your insights and your discussion at the end of it.